Welcome to DePaul University. This is Howard Sorkin, the instructor for the online case study class for the Financial Planning Certificate Program. And this is Chapter 13, an overview of estate planning. Once again, most of you have taken the courses, so you're familiar with it. Be aware of the fact that it says people need to understand about estate planning. And I will tell you, as someone who's been in the industry for many years, I'm frequently telling people, especially young people that have children, and they say, well, I don't have a big estate problem. I said, the most important thing you need to do is have wills and maybe a trust and maybe durable powers of attorney to protect your children so that if something happens to you, you know who's going to raise them. And I frequently refer to accidents where mom and dad both die in tragic accidents, and now there's no one to take care of their kids unless they've taken care of setting that up. Estate planning helps the clients make decisions about the accumulation, preservation, and distribution of their assets and what happens if they're incapacitated. Though estate planning, clients can dispose of property during their lifetime as well as during death, and there's certain strategies to be aware of. One of the strategies that people like to do is avoid probate, which keeps things more private, and transfer assets at a more cost-effective way because they're not paying extra fees. As part of the financial planning process, you should be reviewing people's estates. That doesn't mean you have to act as an attorney to be able to review it. And I always defer to attorneys and try to work with estate planning attorneys that specialize in the area of estate planning. As part of the financial planning process, you're going to analyze the situation and know what the client needs and have an essential idea of what's going on. As a planner, you're not supposed to be the sole expert, but you should have a working knowledge of different ideas to help your client. One of the major myths that people have is that if you don't have a complex, large estate with lots of money, you don't need to worry about estate planning. It's also another myth that estate planning is not only for the wealthy to save money on taxes, but estate planning is very, very complicated. It doesn't have to be. Typical estimates suggest that no more than 40% of all U.S. adults have a will, and the percentage is lower for minorities. Advisors generally agree that the clients that are resistant to implementing estate planning recommendations and postponing visits to attorneys will do so for months to years. In addition, many times they don't want to spend the money and they'll go online and do it themselves, and sometimes they really screw it up. What does the client need? I'm going to say something that I tell a lot of my clients and I've told my classes, that even if you have unmarried, emancipated adult children, that means a child is 18, 19, 25, 30, if they're not married, you may want to recommend that they get a durable power of attorney, have those children do it, because they want to make sure that if something happens to them and they're ill, that there's someone that's going to be able to help them, because the hospital doesn't know that you had a good or bad relationship with the adult child who's not married. They may not want to listen to you. There's a lot of people that want to take care of privacy issues, making sure that certain churches, schools, hospitals all get some kind of charitable donation, or maybe they don't want to have a charitable donation. Determining the estate planning need and focuses on assets, providing for the survivors, especially spouses, and making sure that everything is consistent with the goals and objectives of the client. There's a whole slew of questions. Do you want to avoid probate? What about estate taxes? Do you care about that? Are you concerned about charitable giving? Are you concerned about taking care of a spouse, special needs children, special needs parents, or other siblings? Are there any minor children from a previous marriage or from a current marriage? What about, again, special needs children? And you have to be very careful if you have special needs planning to work with attorneys that understand all the complexities of the law. Do you want to leave a bequest to somebody? And it doesn't necessarily mean $1 million. Document and evaluate their current situation. Keep all kinds of notes, because at some point you may be called upon to provide those, especially if something happens to the estate where they've lost money. The planner must evaluate the strategies and products that are available And again, unless you're an attorney doing estate planning, do not draft documents. It's imperative to determine that if the client has the following when they were drafted: how current are they? Are they in the same state? Were they the same married couple? Did things change with their children? Do they have wills? Are there any additional letters of instruction? Are there medical powers of attorney or durable powers of attorney for health and property? Are there advanced medical directives, living wills, or last wishes? Are there any kind of trusts? Any prepaid, contracted for informal arrangements for funeral and burial? Somebody should help put all that together and make sure that family members know where it is, or at least know where the safety deposit box is. Other documents: birth and marriage certificates, divorce decrees. Some people have more than one. Life insurance policies, the title for the home. Where are all these documents? It says, important to document to review the following. Maybe you want to put together a notebook and help them put an inventory together of everything, as well as where their brokerage accounts are, where their safety deposit boxes are, who the attorney is, who the lawyer is. Are there any significant changes? Do they have life insurance payable to a trust or to an insurance policy or to their estate? Have you done a review of all beneficiaries to make sure that the client who's 60 years old doesn't have a life insurance policy payable to his estate or payable to his mother who's been dead for 40 years? Are things properly spelled? Do they have the right addresses, right account numbers? Have there been updates? Do you have the right copies of the updates? Do you have the right set of the trust documents? Do you understand the way to have property owned? Joint tenancy, tenancy in common, joint tenancy with rights of survivorship, tenancy by the entirety for married couples for real property. And it talks about these 10 states that have either community property or full community or partial community property where things might be owned. Do you understand the differences between these? The community property refers all property while you're married. Everybody legally owns 1/2 of every asset in a community property state. Do you understand how that works? Do you understand about step-up and basis if it's property that's held in tenancy in common? What about the death tax or the estate tax? Now, the information here is not accurate on the slides. You have to make sure you have the updates. But one of the things that is accurate is when you die, you may have to have an estate tax filed within 9 months of the date of death. What is the fair market value? Is the price of the property would have changed hands between a willing buyer and a willing seller? Neither any other compulsion or any duress. The fair market value of a particular item, including the gross estate, is not to be determined by a forced sale. Make sure you understand the concept of fair market value. It's very important. Fair market value, certain things are easier to get, such as securities or cash. But real estate may not have an easy way to get fair market value. It may need to be appraised. This gives you some information, but how do you determine the actual size of the taxable estate? Once the assets have been accounted for, what's the marital deduction? Currently, the numbers on these slides and in the textbook are talking about what occurred in 2010. This is now 2014, and these numbers have changed. It's your responsibility to make sure before the comprehensive exam you know the current numbers. It's also your responsibility to make sure before you talk to a client you know what these numbers are. Gift tax. People are allowed to give a tax gift without paying taxes of all kinds of things up to $14,000 per year per person, unlimited. And it says here what's not taxable. Gifts that are more than an annual calendar exclusion. Tuition or medical expenses paid directly to the institution. Gifts to the client's spouse. All of these, depending on how it's set up, may avoid taxes or may include taxes. This slide number 34, it should be in 2014, $14,000, which means it would be $28,000 for a couple. Anything over that would be subject to your unified credit, but also would require a gift tax to be filed, even if you're not going to pay the tax. Generation skipping transfer. This is tested on the comprehensive exam. Make sure you understand the rules and how it works. Any gift or property is to someone who's 2 or more generations below the person making the transfer is considered generation skipping transfer. Grandma and grandpa are worth $20 million. They forget their own children and leave money to their grandchildren. That might be a generation skipping transfer situation depending on how things are worded. Be careful that you understand what that means. Your gross estate. It says the gross estate would be things in the estate. Life insurance payable, proceeds payable to your estate if the client had any incidents of ownership in the policy. Make sure you review life insurance incidents of ownership. Name the beneficiary. Change the beneficiary. Access the cash value. Collateralize the policy. Access or change the dividends. All these are evidence of ownership, and if you have that, then it's part of your estate. What about annuities? Most annuities are going to be part of your estate, but immediate annuities where you have no residual asset or can't do anything will probably be out of your estate. The value of property transferred in 3 years of your death. Not just life insurance, but any property. It might be transferred in anticipation of death. Trusts and other interests. I think I just went backwards as opposed to forward. The estate tax credit is offset by your total tax liability. Review what's meant by unified credit and make sure you understand it. Okay, I did go backwards. A client's taxable estate is determined by subtracting deductions from the gross estate, such as your funeral, final expenses, and debts, the marital deduction, charitable deductions, state taxes that have to be paid. All of this is deducted. What is the marital deduction? Again, the marital deduction is available for the value of property that passes from one spouse to another. A charitable deduction is available for the value of property that passes to the charity. In 2010, it said it was up to $10 million. Now it's about $5,250,000 per person. Taxable gifts. Did you have to pay tax on the gift? How does that work out? Make sure you're aware of that. Tax credits. If a client's taxable estate plus adjusted gifts is less than, which should be $5,250,000, there's no tax due, but there may be tax in the state because, like Illinois, their adjusted number is $4 million. And pay attention to the state, the year you're going to be taking the exam, that will determine what those tax credits should be. I'm going to skip these slides because you can't read them. What does it mean that income in respect to a decedent generally includes any income that the deceased person was entitled to receive prior to death but was not actually received until after death? Salaries, royalties, retirement accounts, dividends. IRD items must be included in your gross estate. The beneficiary of the income is then taxed at the beneficiary's marginal tax bracket. Pay attention so you understand what IRD really means. It's not just life insurance proceeds. The cost of drafting wills, durable powers of attorney will vary by geography, and many times these costs can be deducted from your taxes. Estate planning strategies, always begin with the basic strategy. Never assume the client, regardless of wealth or income, has anything in place. Start from the beginning, ask questions, and if they say they have this, make sure you see the documents. It talks about financial planning recommendations should not supersede an attorney's recommendations. Financial planners will benefit from their client greatly by following the general guidelines. Make sure you establish the relationship. Make sure you document everything. Make sure you work with the attorney and or the accountants. You don't want to make them your enemy. You want to work with them for the benefit of the client. Assist the client in the process. I typically tell my financial planning clients that I'm more than happy to sit in on the meeting with the attorney should they want me to. Establish a working relationship, and I have 7 or 8 different attorneys I work with, and I tell people up front, I take no referral fees. If I refer you to an attorney, you discuss their fees directly. I take no referral fees. All I know is they're honest and competent. It's very important to me that I know that they're honest and competent. All of this is in your textbook. I'm now going to flip over. One thing is, make sure that you get your client to prepare a current will or review their will. Make sure that there's instructions. Make sure there's durable powers of attorney. You want to avoid probate by using a trust. You may want to establish an AB trust for high net worth people and or for families with young children. You may want to review the rules of CRUTs and CRATs and pooled income funds and donor advised funds. Q-tip and limited partnerships. There's a little explanation in each one of these in the textbook, or you can look it up online. Understand the difference between a uniform gift to minors account and a 2503 B or C trust for minor children. Understand how 529 plans can reduce the estate of somebody. Be aware of the fact that everyone has to know what's going on, and even though people say they do, many people don't. You may want to review before the comprehensive exam what is a charitable remainder trust, called a CRAT. How does it work? The benefit may be structured as an annuity for the life or term certain. The annuity must be paid for the duration of the annuity. So if it's life with a 20-year period certain and you die 15 years into it, the balance of that will be paid for 5 years. And then it talks about how it transfers to the charity and when you get the deduction. A charitable remainder unit trust provides for the donor beneficiary with annuity equal to a fixed percentage. It's a little different. Review these rules because, again, this kind of stuff might be tested along with generation skipping transfer. On my comprehensive exam, I had a case study on generation skipping transfer, and the correct answer to 3 of the 5 questions is this is not a generation skipping transfer situation. Why? Because the money wasn't skipping a generation. Here's the situation. Grandma, grandpa had set something up. Their beneficiary was their daughter with the children as a contingent. Grandma died, the daughter died. 5 years later, grandpa died. The money went to his grandchildren, but it was not a generation skipping transfer situation because it was originally supposed to go to their own daughter. What's a pooled income fund? It's a charitable device created and maintained by a charity. The money goes into it. What is a donor advised fund? Understand the difference. Charitable rules and record keeping. All of this stuff has to be done properly if you want to have the deductions and earnings that you can get to take advantage of making charitable contributions. What's a family limited partnership? How does it work? Well, you basically say that I'm going to be a 1% general partner and I'm going to transfer the rest of the benefits to somebody else, and then they're going to own the rest of the property, but I only own 1%. You may want to review a little bit more on that. And self-dealing says we're going to prevent a donor or the donor family from transferring property to a trust that they can then use to help with their own business. This has been Howard Sorkin doing an overview of estate planning from the textbook. Please make sure before the comprehensive exam that you review the current numbers for what you're allowed for gift tax, for charitable giving, for when the gift tax form is due, for estate planning. Make sure you review everything about durable powers of attorney. Make sure you understand that you should not be filing or preparing documents for people, and make sure you understand all of the phase-ins and phase-outs. Thank you very much for listening. Talk to you soon.